A lot of people are interested in estate planning as a form of tax planning. They like to know how they can structure their estate to avoid as much tax as possible. And in this video, we're going to exclusively look at the concept of gifting as a way to reduce your taxable estate. In other videos, we talk about exemptions, deductions, and exclusions that might be able to reduce the size of your taxable estate, but here we're going to look exclusively at gifting. So in doing this, we're going to look through the lenses of Pennsylvania law, which will apply to all Pennsylvania residents, but we'll also look at federal gift and estate tax, which would apply to all US taxpayers. I'd like to hit quickly on how the Pennsylvania inheritance tax differs from federal gift and estate tax. So Pennsylvania inheritance tax starts at $1. So every single dollar is subject to Pennsylvania inheritance tax unless there's an exemption or a deduction, which we talk about in other episodes. The rate varies depending on the relationship of the person who's receiving the asset to the decedent. So it's 0% for a surviving spouse. It's 4.5% for a lineal descendant. So that's a child or a grandchild. It's 12% for a sibling and 15% for virtually every other beneficiary. The biggest difference in Pennsylvania is there is no tax associated with gifts. So I could make as many gifts as I wanted during my lifetime, and I would never pay inheritance tax in Pennsylvania on any of those gifts unless the gift is made within a year of my passing. And the reason that this rule applies is to prevent someone from gifting everything on their deathbed just for the purpose of avoiding Pennsylvania inheritance tax. Under federal law, gifts may be subject to federal gift tax. So we've talked in depth about how federal gift and estate tax works, but just a quick summary. If you're gifting an amount under the annual exclusion amount, which in 2023 is $17,000, and in 2024, it's going up to $18,000, you will not pay any tax on that gift. You can effectively make a gift of up to $17,000 or $18,000 next year to any person in the world, and you can make that gift completely free of gift tax. Beyond that annual exclusion figure, you may have to report a gift on a gift tax return, but you won't pay any tax until you've exceeded the unified credit exemption, which currently is massive. In 2023, it's $12.92 million per person, double that for a married couple. And next year, 2024, it's going up to $13.61 million per person. So let's talk about how gifting assets can effectively reduce the size of your taxable estate. And in doing this, we're going to assume that number one, these gifts will be made outside of that year window before your death for Pennsylvania inheritance tax purposes. And we're going to assume that your lifetime gifts will ultimately be less than the unified credit exemption, which again currently is 12.92, about to go up to 13.61 million. It's hard to project where that number will be on the date of your death, but let's just assume for the rest of this video that we're going to fall underneath it. It's worth noting that when we're talking about this type of gift to reduce the size of your taxable estate, there are certain rules that you have to follow. For example, you can't make a gift to a trust and then maintain complete control over how that money is used for the benefit of the beneficiary. There are very strict rules about making gifts to trusts. So if that is an idea that you might be interested in exploring, you should speak with an attorney about how to make that gift effectively so that it's not clawed back into your estate for tax purposes. So with that backdrop and with those assumptions, we're going to talk about what assets you might consider gifting. So any gift that you're making is effectively reducing the size of your taxable estate. So that's great. You avoid estate tax potentially. You avoid Pennsylvania inheritance tax potentially, but there may be other tax consequences that you're not really thinking about. So what do I mean by this? Okay, if you make a gift of an asset that has highly appreciated during your ownership, Not only are you making a gift of the underlying asset, but you're also transferring your cost basis, your tax basis in the underlying asset. It's called a carryover basis. So the person who's receiving the gift, the donee, receives the tax basis of the donor, the person who made the gift. So I'm going to give you a concrete example. Let's assume that you purchased Apple stock for $10 a share. That means that your cost basis in the Apple stock is $10 per share. And let's assume that the stock price is currently $200. The unrealized gain that you have in that underlying asset is the growth, the appreciation. So it's $190. If you make a gift of that stock, the person who receives the gift is assuming your $10 cost basis. So if they sell it, that sale triggers a recognition event, and tax would be due on the appreciation in value of $190. So that $190 gain, that's a capital gain, will be subject to capital gains tax at whatever the effective rate is, anywhere from 0 to 20% under current rates. So you would be paying potentially up to 20% tax on the $190 growth. So when you're making that gift, you're also gifting your baked in capital gains tax. So if you're making that gift as a way to reduce your taxable estate, especially if we're looking at Pennsylvania inheritance tax, it doesn't make a whole lot of sense because you're making that gift and you're avoiding, in most cases, a relatively low tax rate. Very often we're looking at children, so that is 4.5%. But even if you go up to the highest rate of 15%, if you would end up paying 20% tax, capital gains tax, when you sell that asset to avoid a 15% tax, the numbers don't make sense, even though that original $10 cost basis is not subject to capital gains. If you run the numbers, you'll see that in many cases, this isn't really an effective tax planning strategy. So what do? Well, you can gift assets that have not highly appreciated. And you might ask, well, isn't the person going to pay the capital gains tax anyway? If I hold that asset until I die, they're going to have maybe a potentially worse tax consequence when they inherit that asset. And the answer is, under current federal law and state law, no. Because when you receive an asset as part of an inheritance, you get what's called the stepped up in tax basis. And that effectively means that my cost basis becomes the date of death value. If I'm the beneficiary of that asset, I receive that asset with a cost basis that is equal to its date of death value. So the step up in tax basis is one of the best estate planning strategies, at least something that we're very mindful of. When we're looking at different assets, if someone comes to me and they're interested in making gifts for the purpose of avoiding inheritance and estate tax, we look at what underlying assets they own. We try to avoid any assets with a baked-in capital gains tax consequence, especially assets that have highly appreciated over time. We look at things like cash or cash equivalent, or things that were purchased recently, something that isn't going to give the recipient of that gift a baked-in capital gains tax consequence. I hope that you found this episode helpful. This is one of many where I'm going to start talking about tax strategy and ways that we can incorporate tax law into estate planning to yield a favorable result for you. Again, I hope you enjoyed this video. If you do like this content, please let me know, and I will look forward to seeing you in the next episode.